Okay, good morning, everyone, and welcome to this morning's edition of the Coffee Microcaps morning meeting. My name is Mark Tubb, and I'm the founder of Coffee Microcaps. For anybody who is joining us for the first time this morning, and for all our regular attendees, you're very welcome back to this morning's event. I'm just going to quickly run through some slides here, and then we're going to get straight into it. And firstly, I'd like to thank Luke Winchester, Merweather Capital, for their sponsorship of our virtual events. Luke's fund, I believe, is going to be launching now in and around the 15th of this month. So if you're looking for a new microcap fund manager, be sure to get in contact with Luke. Just quick compliance and disclaimer slide. For anybody joining us for the first time this morning, the companies we generally have on here are under 300 million market capitalization, in revenue and approaching cash flow break even, or indeed are already profitable. We generally don't have companies from the resources or biotech sectors. They're what I like to call industrial microcaps. That could be microcap technology names, microcap financial services names, microcap industrial products or services businesses. And that is what we'll generally have on a week-to-week basis here. Structure this morning's webinar, as always, we'll have two companies presenting over the next hour. Each company will get 30 minutes, which will break down to roughly a 20-minute presentation and then 10 minutes for Q&A. If you do have any questions for our presenters, please type them in the Q&A box rather than the chat function. Just makes it easier for me to moderate the questions at the end. Please note the webinar is being recorded and it will be posted on the Coffee Microcaps YouTube channel tomorrow morning. Follow Coffee Microcaps. You can, Twitter is probably the best case to get us, YouTube for this recording, and indeed all the other recordings of our morning meetings. This is the 52nd edition, so there's plenty of content to check out there. LinkedIn, and I also write a weekly paid subscription newsletter where I profile one interesting microcap stock every week. You can check that out on the Substack newsletter platform. Up first, we've got Ensurance. We've got Tom Kenton, Tony Leibowitz joining us. And then straight after that, then we've got Mark Watkin coming back to present again, give us an update on BikeExchange. So without further ado, I'm going to stop sharing my screen because I know Tom is waiting patiently to start his presentation. So Tom, if you want to start sharing your screen, and I'll let you know when I can see the cover slides coming through. Yep, perfect. You're good to go now, Tom.
How's that?
That's perfect.
Can everyone hear me okay?
Yeah, you're coming through fine.
Perfect. Excellent. Well, thanks, Mark. Yeah, really appreciate the opportunity to be here today. It'll be really good to get some fresh sets of eyes looking over our company. So we've also got our chairman, Tony Leibowitz, on the call, and he'll be on hand to join in the discussion at the tail end of the presentation as well. So this morning, I'll firstly give an outline of our operations, and then we'll have a look at where we sit in the the scheme of the wider insurance sector. And finally, I'll touch on the core components of our strategy for growth over the next few years. So before we take a deep dive into the inner workings of our operations, I'd say the most important point to dwell on and take away from today's session is that we're a profitable, nimble, and passionate insurance underwriting company. And we've got a big vision for the future, both here and in Australia, and abroad as well. So this past financial quarter, you'll see in a few of the highlights I've listed here, it's been transformational for us in the sense that we're now cash flow positive. We've achieved our maiden quarterly profit, and we're going to continue to build on that profitability through prudent management across all areas of the business. So we have a high margin and low risk model. It's deployed with our business is based on having empowered staff, and they're all equipped to swiftly make decisions, ultimately building a significant portfolio full of insurance premiums, to the maximum amount we can The idea is to build this well beyond the size of any underwriting agency in Australia. It's important to note as well that our model is based around having very sticky business. It's almost like a software as a service model. So the typical annual retention rate for an SME client of ours is in excess of 85%. So typically once we've got something on our books, it doesn't usually leave unless there's a warranted reason. Likewise, the agreements we use with our insurance partners who actually sign off on the risk for us or issue the insurance policies are also based on long-term propositions and partnerships as well. Lloyd's of London and AXA globally are strategic partners of ours, and they value the vast distribution network we offer to them by virtue of the insurance broking houses that utilise all of our products. The products that we offer listed here, probably the highlights among those would be construction liability, public and products liability, and we're moving into emerging classes of insurance such as cyber, terrorism. All of our products have been customised and launched into the insurance broking market quite quickly. And the key priority of ours is just to set a higher standard of customer service than brokers are typically receiving, from your day-to-day insurers. And lastly, from this slide, we've recently acquired, integrated and rebranded an Australian-based underwriting agency, which was my previous business, TK Specialty Risks. And this was done over the course of what was less than 3 months. And so that's established for us a blueprint, which we'll be using when we're seeking out other earnings accretive acquisition opportunities. So I guess now you're aware of what we do at a high level. Probably logically, the next question is, how do you actually make money? The short answer is that we make money by boldly going where insurance companies have not typically gone before, and offering to bring the insurance companies along with us, provided they sit in the back seat. So the traditional model here, which you can see on the top level of this slide, is based on the insurer. So let's say it could be CGU or Zurich releasing a product. It could be business insurance to the insurance broker, who then obviously sells that onto the customer. The customer elects to buy the insurance product. They'll then pay the insurance broker their insurance premium. The insurance broker will then collect the commission from this payment and then pass the remainder over to the insurer. So from this pot of money, the insurer will then have to pay its underwriting staff, administration costs, and of course, the claims payouts when there are claims. So the bottom diagram here, which is our model, it outlines the underwriting agency or the managing general agent model. You'll note that these terms are also interchangeable. So some people refer to them as underwriting agencies, others MGAs or managing general agents. Either is fine, but probably the preferred term is MGA, certainly when you're discussing it with Lloyd's of London as well. So as you can see here, the MGA business sits as a conduit between the insurer and the insurance broker. So under this model, the insurer will typically pay a higher rate of commission, and then both the broker and the MGA would then share the commission on the basis of a pre-agreed ratio. For example, here in Australia, we'll take 30% of a transaction and then we'll pay away between 15 and 20% to the retail insurance broker, depending on the parameters of the agreement that we've set up with them. So for the insurer, this is a lightweight solution to securing a revenue stream. It could be for any number of reasons, either a new product, new geography they're looking to enter, but the beauty of it is there's just no unnecessary capex for the insurer. They sort of rely on the MGA to do all of that and just collect a payment and a list of policies at the end of every month. So despite the fact that MGAs aren't commonly discussed or even really known about in the retail or the domestic lines of insurance, in the commercial and the broker-based segment, it's very common. I mean, even in Australia alone, there's well over 50 MGAs in operation. So insurance is a classic example of this model. Everything we do looks and smells exactly like many other underwriting agency businesses. But we have a few key exceptions. Firstly, we're the only ASX listed MGA which isn't affiliated with a broking-based business. There's other listed businesses which have underwriting agencies in their fold, such as Steadfast or Austbrokers, but we're fully independent, and so we service all insurance brokers who want to deal with us. And I'll touch a bit more on that later. Secondly, we're the only ASX listed MGA which owns 100% subsidiary in the UK, which is a really important thing and certainly a feature of the group which attracted me to it prior to selling my business to ENA. The main reason for this is the old Commonwealth lines of trade are still sort of running strong and true in Australia, and a significant proportion of all insurances placed here are in fact underwritten via insurers at Lloyd's of London. So in my view, these are two key features of the business which make it stand out from other MGAs. We can trade on a forwards multiple of revenue. We can scale quickly due to faster access to capital. And of course, we can achieve better results for our broker partners when dealing with the UK markets because we own an MGA in the UK. I mean, typically, if someone is trying to get a result for a difficult hard to place risk out of London, it's normally a case of waiting for weeks. Whereas the fact that we actually own the business over there, means that we can achieve those results a lot faster. So in terms of the corporate organisation, this sort of simple structure you see in the middle of this slide, we've got two divisions, the UK and Australia. The UK business is now in its 5th year of trading. It's actually got an office in Manchester as well as London. And the primary focus is really around construction products and terrorism lines of insurance. As I mentioned, the Aussie division here was formed more recently through the acquisition of my business. And our main focus is on professional and financial lines. So we do all manners of professional indemnity, different professions. We do professional indemnity for fund managers, stockbrokers. So it's very different to what the UK business is doing. And I'll talk a little bit more about the importance of that diversity as well in a couple of slides. In terms of staffing, we've got about 25 staff across the group now. So sort of 16, 17 in the UK and the balance of them being here in Australia. And on the right-hand side, just a quick snapshot of the shareholder information. So you'll see that it's a fairly tight register. We've got over 2/3 of the shares on issue being held by the top 20, and almost 1/3 of the shares being held by board and management. In terms of the substantial shareholders, the top two listed shareholders there are Tony and myself, respectively. Now for the board and the senior management team. Tony, as I mentioned, is the executive chair. He's got a long history in financial services companies. And probably more recently, he was one of the founders of a good ASX success story, Pilbara Minerals. Tony Wiebe and Sam Halib are the non-exec directors, and clearly they've got a strong accounting pedigree as well. Tim James heads up the UK division, and I'm running Insurance Australia. I've just put up some financial results here to give a feeling for how we're tracking year on year for the first quarter of the financial year. I thought this was probably the best outline of the way it's trending. I mean, in terms of the annual reports for the past couple of years, it's not really a true picture of where we sit, because it was just the UK business which we were reporting on. Mind you, the revenue was jumping significantly from year to year in the UK anyway. I think we went from about 3.6 mil on the top line to 4.4 for 2021. But it's really as we put these businesses together that we're starting to see some excellent financial metrics. So 44% growth in insurance premiums under management. I mean, in our industry, we call that gross written premium. Gross, of course, because it incorporates commissions paid as well. So you can see the exact cost to the insurer. But a loose equivalent in the fund management world would be sort of funds under management. And in terms of the revenue line, obviously we're happy with the result here, sort of being up 130% on the prior period from last year. And we've just hit profitability, a minor sort of that it looked like zero there, but it's, you know, a few $100. But obviously you can follow that trend from the bottom up. We're excited about the upcoming quarterly. So in terms of the growth, yeah, look, it's obviously been strong. It's in line with our expectations, but yeah, we're comfortable with what the staff are achieving. But what is really exciting is when we look at the amount of addressable market which we're in for our current product set. I mean, we're servicing an addressable market of well over $5 billion in premiums. So we're fishing in a very, very large ocean. And probably even more exciting than that is, you know, each new product that we roll out, or each new staff member that we hire, or new acquisition that we make, we're obviously going to see that addressable market size only keep increasing. I just wanted to circle back to the comment I made earlier about the fact that some MGAs are owned by broking houses. You'll see from this diagram here on the left that in broad terms, MGA businesses tend to fall into three different categories. So you've got the independents, which is where we would sit. Mind you, the independents typically aren't listed. We're certainly the only one in Australia. Then there's a broker-owned model, MGA, and that's where you see the likes of Steadfast, PSC, or AUB on the ASX. And lastly, there's insurer-owned MGAs as well. So whilst each model really has its own merits, I mean, you can talk about the positives of each one till the cows come home. For example, you know, if a broking house is going to own its MGA, then it makes it very simple for the brokers to place business through to the MGA. So the brokers are all going to have a ready-made solution for a high percentage of their clients. So the broking house could release a product, let's say for an insurance product for real estate agents, and then they would establish that MGA in-house to place those real estate agents through to. The downfall of this model is if you have too many claims or you can't get enough premium, then the MGA isn't sustainable. You know, there's not enough business coming through, and a result of that, you could have one or two claims and have the security pulled from you. If there's under the insurer-owned MGA model, that typically has been established by virtue of some sort of acquisition. So the example I've put there with Brooklyn Underwriting was an acquisition done by AXA in Australia in 2015. Brooklyn had roughly $30 million of gross written premium, and AXA paid $30 million for the business, dollar on dollar, which was a big deal at the time. But from the insurer's perspective, the beauty of this is that they can acquire it, the GWP flows into the insurer business, and then they can decide what to do with the brand. They could either divest it later on or merge it in-house, rebrand it. So it really, the model that we want to follow and will keep on following for as long as possible is to maintain our independence, not only because it allows more brokers to set up agency agreements and trade with us. In fact, we've just signed on our 100th broking partner here in Australia. But also down the track in terms of M&A, the multiples achieved for independent broking houses are typically much higher. A good recent example is in the UK, CFC Underwriting, who I've put the logo of under the independent tag there. They've just had a venture cap firm join the register in a fairly unprecedented multiple of 40 times EBIT. So the valuation of that business is now close to $2.5 billion. Now, juxtaposed with this is the other sort of key aspect of our bipartite strategy with the UK and the Australian entities. The two businesses that really going to act as buffers for one another when the market cycle changes. So if you look at this diagram here, where you've got the hard market at the top and the soft market at the bottom, where insurance premiums are going up, that's where we enter what's called the hard market. So the example would be in Australia at the moment, professional indemnity insurance is experiencing a hard market, particularly for the engineering classes. So the underwriting team that we've got here are able to charge more than usual for the products we offer. But on the counter side in the UK, something like a terrorism product is a bit softer. So you can't really expect clients to pay more for the product. And coincidentally, I know Tony's on the call, so I won't flatter him by saying it was a stroke of genius, but just as the Lloyd's markets were sort of retreating from Australia a few years ago, was the time that he decided to fund and set up the UK entity. So it's almost as if the UK business is raring to go, just as the wider markets are looking to Australia as we're moving from the hard market into the soft market. So while everyone will be sort of scrambling around to try and get their products ready, ours are already ready to be rolled out into Australia. Okay, so in terms of the little pie chart here, what we should be looking at is the diversity. I know there's a lot of little slices which don't seem to add up to much, but in fact, what we're really looking at is about a $40 million gross written premium portfolio across all of these classes. So where we have this diverse set of products and premiums flowing in from selling these products across the wider business, we're achieving this unique resilience to any market jitters, any of these cycles which we outlined in the previous slide. So the message here is that, much the same way as we value our independence and don't want all of our business coming from one or two broking houses, we also don't want all of our revenue being derived from one or two products. So we've got this nice spread of business across a dozen products, and we've also got partnerships with no less than 8 insurers who are backing these products, which lays the foundation to add further products to the armory over the coming months. And so finally, just onto the outlook and the plans for next year. We've got a number of major goals. Firstly, we want to be fostering the intra-company relationship, distributing the UK products into Australia. It's just a natural and simple way for us to achieve organic growth. And it also it gives us a huge advantage over our competitors. Secondly, we've recently just raised a touch over $2 million to roll out new products in the UK, hire some staff in Australia. The main aim is just to hasten the growth we're seeing in the current hard market here, and just keep looking for some earnings accretive acquisition targets, which are going to suit our business model. And lastly, and just expanding on that second point, we're really going to shift our focus from the smaller states in Australia. We currently operate Western Australia, South Australia, like I said, but we've been waiting for an opportunity to expand into the East Coast aggressively. And recently we've hired Nick Beswick, so he's agreed to come over from AXA, who are our security on our professional indemnity products, and that was a real sign of the strength of our partnership with AXA for him to be joining us. So he'll be starting in January to open our Sydney office, and from my perspective, obviously that's just going to be starting probably the biggest chapter in the company's short history. So on that note, thanks once again. Any questions that spring to mind after the session, feel free to reach out to either Tony or myself.
Thanks, Tom. Maybe I'll just kick off the questions, if I may. In terms of acquisitions, are you looking at both the UK market or just the Australian market on a kind of go-forward basis?
We're looking in both areas. I would say, obviously, my remit is to concentrate on Australia at this point. But there's a sort of short list of, say half a dozen key targets, both there and here, based on product diversity, size of the MGAs that we're looking at. And it really is a case of finding the right organic fit. But I wouldn't say it's limited to UK and Australia. If we look further abroad to New Zealand is a great example. So AXA, who I mentioned, back us on a lot of our products, whilst they don't have a license to write insurance in New Zealand, they can do that by virtue of being in Australia, but they can't necessarily market in New Zealand. So we could potentially look at taking that on or acquiring an agency over there. And so we're actively looking, that's for sure. Doesn't have to be here, just here and in the UK.
And then the 5 billion, addressable market you referenced across principally 2 products, the construction engineering and the kind of sabotage term one. Is that very fragmented in terms of the MGAs kind of serving it? And are you kind of looking to say, okay, well, we're going to be the dominant specialist in those specific lines of business?
For an MGA of our size, it's probably more a case of not flagging a particular percentage or a target percentage, but saying, along with a number of other insurers and MGAs, would be looking to try and get sort of 5 to 10% of market share. So that sort of aggregated figure across a number of different lines, mean, take Australia, for example, the professional indemnity market is 1.5 billion. Our professional indemnity insurance book, through to financial year end 2023, will be closing in around the $25 million mark, or that's what we're hoping. So it's obviously a very small percentage of what's available. However, typically, once you manage to get enough of a reputation for servicing those sorts of products well, it snowballs quickly. I mean, we've really only been doing these particular lines for the last couple of years, and the compound growth, as you can see, is certainly more exponential than linear. So hopefully that clarifies it a little.
And then I might just bring Tony in for one last question, because I know we're pushing up on time, and Mark, the other Mark who's presenting next, is waiting for us. Tony, if I may, a business I'm familiar with based out of Norway is Protector Insurance. I'm just wondering, it's also listed, I'm just wondering, would that be a reasonable comparative business listed internationally? From what I understand of their business, it sounds like very similar to Ensurance, but obviously on a bit bigger scale.
Mark, I'd love to be able to answer your question with some knowledge, but I can't. I've never heard of it. I just saw insurance as an opportunity that we needed to take advantage of. I don't know enough about listeds other than the majors, and mainly in the UK and the US. So I really don't know. What's the name of it? Because I'm happy to do some work on it and come back to you if I can.
Yeah, they're called Protector. I think it's just Protector Insurance. They're listed in Norway, and they exclusively service, the broker channel. And I don't think they're an insurance business of the three models that Tom put up. I think they are more a clean MGA, if we can say that. I could be wrong. Insurance, as Tom put up, you can have three different types of models, so I'm not 100% sure. But your presentation versus a presentation I've heard from those guys, sounds very, very similar.
I'll follow this up, Mark, and if you can give me the benefit of coming back to you, I'll do that.
That'd be great.
Yeah, even if you want to send over their presentation, Mark, we'll have a look for you.
Okay, perfect. And then I might just put some additional comments from yourself, Tom, or Tony, in the show notes for this episode in due course.
Right.
I know we have gone slightly over time, so I'd like to thank Tom and Tony for joining us this morning. And Tom, if you could stop sharing your screen, please, as I do know Mark is waiting for us patiently. Mark, if you want to start sharing your screen.
Yeah. Good morning, everybody.
Yeah, I can hear you, Mark. You're sounding good.
That's a good start.
And yeah, if you just go to full screen mode or slideshare mode. It might just take a second now, because as you're doing it from Google Drive.
Is that coming through?
It hasn't flipped to full screen mode just yet.
2 seconds, I know why that is. It's we've got two screens going on here, so just give me 2 seconds. Nice. They're coming through now.
It hasn't changed.
Interesting. This wasn't in the plan, was it?
No, and it worked perfectly in our test run yesterday.
Yeah. Let's try one more time.
Okay. So I can see the slides, but it's just not in slideshare mode or present mode, sorry. I think we're There we go, Mark. Perfect. Now we're good to go.
We got there. All right. Good morning, everybody. Thank you for joining this morning. My name is Mark Watkin. I'm the global CEO of BikeExchange. I'm going to take you through the journey of BikeExchange, a little bit about the business, particularly since we listed the business in February of this year. And very happy to take questions at the end. So BikeExchange, it's one of the world's largest pure, dedicated online cycling marketplaces, a single category. Started in Australia 14 years ago, and since has expanded into 8 countries or 4 regions and hubs: ANZ, North America, Europe, which is Germany, Belgium, and Netherlands, and Latin America, Colombia, where we've got a presence. And effectively, what we're doing is we're creating a network of brands, retailers, cycling stores, and distributors into single destination marketplaces. Each of those regions has or countries has a separate instance of the marketplace, which is predominantly dictated by the individual sellers and the products that are in those regions. But we've got global traffic of around 28 million, over 1,500 different brands on the platforms, around 1,650 active retail accounts, and we're generating over $1.6 billion worth of sales lead value, which, there's some legacy in that. We started the business as a classified listing business, pushing leads and inquiries through to sellers, and as e-commerce has become more prevalent, we're doing transactions on the platform too, and I'll talk a little bit more about that as we get into it. Cycling as a category it's in a very interesting phase. Some people are calling it as a generational revolution happening, and a lot of that is being brought on not only by the realization that cycling is a mode of transport as well as a recreation and a sport, but also by e-bikes, investment into infrastructure to make active transport a viable option. And then you've got the environmental, health, convenience aspects of cycling. So very topical, and particularly through COVID, there was heightened sort of emphasis on that, but we're seeing that continuing. In Australia, the Australian Cycling Economy Report was published a couple of weeks ago by Ernst & Young. Some really prominent statistics in there as a first sort of report that's been done of that nature. But we're seeing 40% of adults spending on cycling, which is really strong figures, and we're seeing over $450 million spent on infrastructure in Australia in 2020. These trends are the sort of trends that we're seeing around the world. Europe is probably a little bit more advanced in the countries that we're in because of the sort of cultural aspect of cycling. But as a category, we're seeing the next 5 to 10 years as a really strong runway, particularly for the mass uptake of cycling. We've got an established presence. We've been going for 14 years, as I mentioned. And really, as we go into each of those markets, it takes 4 or 5 years to establish the marketplace, getting organic traffic, getting the sellers on, and getting quality product. So we've got a very good, strong foundation. And our marketplace is e-commerce enabled, as I've said, and we're finding that predominantly as sellers come onto the platform now, they're e-commerce enabled first. But we do have a diverse revenue model. So we have a subscription side to the business for sellers coming onto the platform, as well as a commission take on sales. And I'll talk a little bit about that as we get into it. But since the listing in February, we've really focused on 3 core areas, which is around sellers, stock, and transactions, which I'll expand on. How does it all work? Well, we've got that strong customer base coming through globally over the 8 instances of the marketplace. We've got a central product database and a central admin site, which sellers have visibility on for their presence. And a huge piece of work that's happened over the last 3 to 4 years is integrations into live point of sale systems. So we get live inventory coming up onto the platform, which helps the sellers from a management point of view. They choose to publish what they want from their inventory, but it also gives a better customer experience with live inventory and availability there on the site. Breadth of choice is a really important differentiator, particularly when you look at pure play e-commerce platforms that typically will have a skinnier offering of brands. Breadth of brands for us is 1,500 plus, from bikes through to P&A, parts and accessories, and associated areas. So that really gives a rich experience to the customer when they're shopping the market, and breadth of choice and coming to one destination is a really important aspect of Bike Exchange. How we're generating revenue? Well, at the subscription side of the business, there's some legacy there where we were always charging subscription to come onto the platform, and that's still very much the case. Once they've got an integration and that point of sale system is connected and the live inventory coming up, they've then got the ability to sell live on Bike Exchange, publish, monitor their sales, inquiries, and fulfill orders as the customers come onto the platform to purchase or inquire on products. Then the e-commerce transaction side of the business, a small example there, if a customer purchases a $2,000 bike on Bike Exchange, once the seller sees that sale go through and they acknowledge the fulfillment of that order, or indeed click and collect of that order if it's in store, we then automatically batch release the funds. We're the merchant of record, so we collect all of those funds. We release those funds to the seller, less a agreed commission on that purchase. We've also got a tertiary sort of revenue stream, which is made up of media. We've got a programmatic media display system running on the site, some direct media sales, which historically have been bigger revenue streams. We haven't focused on that area in the last 2-3 years, as we've focused on our two main revenue drivers. There's also some private classifieds for second-hand bikes, which is probably around 1% of our total. It's one of the big areas. Is obviously most of our listings, 99% of our listings are new inventory, but the second-hand market is something that we're looking at as we progress, and there's some ancillary sort of feature upgrade services and the like as well, which generates a small amount of revenue. So just looking, we've obviously gone through a couple of cycles now of reporting to market, and we did our full year in August with an annual report, just some themes from that, and I'll also touch on the Q1 results, which we published last week. You know, we were really pleased with our first sort of full year, notwithstanding that 8 months of the year was taken up getting ready for the listing in February, as well as trying to grow the business you know, in parallel. But our total transaction value was up 93%, strong growth across all the regions, but Europe was very much a standout. 10% growth on those active retail accounts. The traffic sort of topping out at just over 28 million. The big sort of growth areas, and it's really driven by this e-commerce first strategy, is the e-commerce commission revenues growing, you know, over 270% there, and the transaction growth sort of growing 60%. Through the IPO, we raised 20 million in capital, cleaned the balance sheet up, and then a very firm focus on sellers, getting the acquisition side of the business, more sellers accounts coming onto the platform, the stock and inventory, quality product, and then transactions. And I'll talk a little bit more how we're focusing on those areas. And some of the key metrics, which I've touched on a couple, but just to call out a few others. You know, average order value, you know, up just under the 50% there, largely driven by the propensity for bikes to be purchased online. That's sort of moving in the right direction, and it's different by market. Over 85% of our transactions in Europe are bikes. In Australia, it's around 30%, with probably a larger propensity to buy parts and accessories online. One of the interesting trends that we started to see in Q4 of FY21 is that the contribution from commission revenues started to exceed the subscription revenue contribution, and this is a trend that we think will continue as volumes start to increase. Commission rates there, increasing about 3.2% there over the year, which is heading in the right direction. We've got ambitions of getting to a double-digit commission sort of average there, but encouraging signs in that first full year reporting. As we get into Q1, and we spent a lot of time in that last quarter of FY21 structuring the business, aligning on those sort of core focus areas, the sellers, stock, transactions. We've designed our executive team around those three areas of sellers, stock, transactions. Three appointments that we made in the sort of last quarter. Sam Salter, co-founder, came back into the business to run our sales and partnerships globally, which is a really great appointment given his knowledge of the cycling industry. Sam had been working in Marketplace, which was a sister business. We demerged those businesses before our IPO. Marketplace runs the technology that BikeExchange sits on. They resell that technology to other brands as marketplace solutions. Derek Colfer came in as regional lead of North America, ex-Visa executive. He came in August. And Ryan McMillan, who's been the lead in Europe, has taken on the role of global head of technology operations to drive through technology projects which are going to enable the business internally and externally. And then the newest appointment, which we announced last week, is a Chief Customer Officer, Rebecca Boxall, who is joining in December. Great appointment. Rebecca's going to be looking after that whole customer pillar, which encompasses marketing, e-commerce, merchandising, and then customer service, really getting us to a world-class customer service offering. And through that sort of executive leadership structure, we've now really looked at how we work across regions with those functions, rather than working in isolation of different regions. 80% of our business is sort of common to all markets. And so we're trying to get the best of each of those markets happening across all the regions. And so far the signs are really positive in that area. A couple other little call outs that we've been doing a lot on our SEO. Traditionally, we've always had a strong SEO program in place. 85% of our traffic comes organically. We've engaged with a third party to enhance that even further, given its importance. And we've had some really positive work happening in the last 3 months in Australia, which has now rolled out into the other regions in the last 6 to 8 weeks. Some of the metrics from our Q1, and again, heading in the right direction, which is, very positive. That e-commerce revenue growing, over 200% versus PCP. The transaction growth up there, 20%. And that average order value, again, versus PCP, all good. And the nice thing is that, traffic was down on last year, which we were reasonably comfortable with, because that initial lockdown period that was being felt around the world really did increase traffic significantly. And as that's come back down to sort of normal levels above where it was prior to COVID, we're really encouraged with how conversion is going. We've still got a long way to go there, but it's definitely demonstrating quality of traffic coming and propensity to make the transaction on site. And really that graph on the right is just indicating where we sort of come from with e-commerce transaction value quarter on quarter, since Q1 FY21, which is really positive. And the account metrics, subscription revenue increasing there at 12%, subscription revenue 6%, ARPA slightly down. We're again reasonably comfortable with that. No great alarm bells. Mix of accounts is the the biggest sort of contributor to that. One of the big areas that we've worked with is working with the brands direct, not to cut the sellers out. We're working with those brands to hook into their stock centrally and then make that stock available across dealer bases. And there's a few examples of that happening in this region, and we're working on some other partner examples overseas. Some of the other announcements we made last week in our Q1 update, we've progressed with to a non-binding indicative offer to our Colombian region, where we've had a JV in place for 4 years. We've agreed to purchase the remaining 50% of that Colombian business. That's a really important decision for us. It's our commitment to that region. We just shortly after listing in February, we announced a partnership with Autoco in Colombia, which is the leading distributor of bikes and electric vehicles. They've got a very strong infrastructure there, and that partnership was all about setting the roadmap for region growth beyond just Colombia into those other LATAM countries, Mexico, Chile, and we're expecting to begin that progress into those markets in the second half of this financial year. So really positive sign for that region, and we're really encouraged by the activity and the leadership down in that region. We've also had some other M&A activities happening, advancing in the right direction, and if that continues, we'd anticipate a further announcement in Q2. So from a summary of an outlook of where we've been, and we're very encouraged by the first few weeks of Q2 from a transactions and account sign up versus PCP. That executive team now in place, and obviously Rebecca starting in December, has been a really positive move from the structure of the business and just the focus areas, making sure that we've got some efficiency and effectiveness. From the capital raise, we've been investing in those areas with some key projects to sort of land in the second half of this year, but all focused on that sort of e-commerce first strategy. The M&A opportunities with Colombia is one, but a couple of other discussions happening there, and we'd hope that comes to fruition over this quarter. And we've had a lot of sort of consensus revenue out in market. We've got 3 research papers out there from Morgans, Shaw's, and CCZ, which is really nice to have that so early in the piece. But we're confident at the moment that we're going to be exceeding those sort of consensus revenue expectations in FY22. So it's been a big 18 months for the business with that capital raise, the IPO, and getting into the rhythm and cycle, but continuing to grow the business. But a lot of positive steps so far. So that just over the 20 minutes, but happy to take any questions now, or please feel free to email them through to the investor relations email that you've got there on the screen.
Thanks, Mark. I might just kick off the questions to start. You touched on the supply chain issues, which a lot of companies are seeing globally. Do you think it was a major issue in terms of the e-commerce growth? Because the e-commerce growth has been, excellent, and I just wonder what it could have been if these supply chain issues that we're seeing right across the globe hadn't been impacted, or is it kind of it's the odd product here and there. Strax trying to get their products to the UK, for example, but Strax in the US. There's no problem getting its stuff out to its US market. So I'm just trying to gauge how much of an impact you think it had on an overall basis.
Yeah, it's been really interesting to follow, and it's let's call it as is. It's continuing, but I think one of the great strengths of BikeExchange is the breadth of choice. And what we've found, we've had had a concierge service running on the platform for customers to help them sort of navigate purchases. Bikes, can be technical purchases, so we've been trialing that as a customer service tool. But where a bike, someone wants to get a certain type of bike and it might not be available, we've been able to navigate them towards a similar bike, might be a different brand or specification, but similar budget. So they actually, can make a transaction. And that's a real positive because of that breadth of choice. It's not like we've only got 2-3 brands. So in those cases, we've been able to navigate really well as obviously going across the seller base. And it has, of course, you touched on it there really well, Mark, it's been slightly different by region. We've heard stories of stock being intercepted and shipped to another region when it was destined for an alternative, and so that happens. But look, largely we've helped navigate the sort of logistical and shortages that have been there. It has predominantly been componentry that's driven it, so it's not necessarily the frames and the bikes itself, it's the componentry that goes on the bikes. That's been the big trend, and there's definitely been some shipping sort of logistics issues playing through. Pricing and so forth has been felt, but in the main we've navigated it well. A couple of things that we introduced, one was pre-ordering, and we saw a big uptick in pre-ordering over the last 12 months, where people are very comfortable to wait 6 weeks, sometimes 8 weeks for that new bike. And so that's been it was a really interesting sort of development, and helps the brands maybe launch bikes on the platform and get some pre-ordering happening on that product line. So it's going to continue to play out as sort of logistics and so forth catch up, and manufacturing catches up a little bit over this next 6 to 8 weeks. But being able to navigate has been a big plus of the platform.
And then a question from the audience. Operating cash flow continues to grow more negative each quarter. When do you see cash outflow starting to decrease? I think maybe if we rephrase that, there's been a lot of investment in bringing new talent on board and investment into the platform. Maybe just give us a sense of kind of where you are in that phase of investing for growth versus capitalizing on previous investments.
Yeah, sure. I mean, I think, we obviously raised that 20 million to invest into the business. So, those investment areas were, as we outlined in our prospectus, were around talent and getting the key skills in. We'd run the business in a pretty skinny fashion. It was a capital light business, and the headcount was around the 45 mark. Today we're at around 80. And so all of that, the talent has been predominantly, put the executive team to one side, Salesforce, seller success, and then some technology skills. And it's not, I don't think we're going to, our headcount's not going to double from here. I think sales would increase as one area. Some of the technology investment that we've got happening, we're scoping out a new front end to the site. In effect, the site's going to become headless. Marketplacer is our technology engine, but we're going to go headless on that front end, really to help with conversion, a little bit more control of that front end, which is an important step forward for us. And we're predominantly living in a headless world now from a technology standpoint. So yeah, we expected that investment a little bit more continuing this year, and from a cash flow positive, we'd be looking back in next year into 23, where we're in a positive way. We've obviously got a couple of acquisitions that we've been talking about. The Colombian one is predominantly an equity-driven transaction, so that doesn't create too much worry there from a cash flow point of view.
And if we can just touch on the acquisitions, are the acquisitions more expanding into existing regions, so getting a few more countries in Europe lined up, or Central America, or is it trying to get a foothold in new regions? When I look at your map, we've got nothing in Africa, nothing in Southeast Asia, Japan, for example. Maybe just give us a sense of where you're looking for these acquisitions.
Yeah, I think that there's probably two answers to that question. The first is the regional sort of expansion. Very much we're focused on the regions we're in. We've got huge runways in Europe and North America, notwithstanding Latin America is a big region too. And getting those first two right is a huge focus for us. So, acquisitions that we've been sort of looking at have been very much in the sort of service product area. Anything that can take friction out of the journey is an interesting area for us, the customer journey, that is. And, there's a variety of others that we've been looking at, but very much in the regions that we're in. And I think the other lens that we put over any sort of acquisition targets there is they might be in one region to start with, but, can that business be replicated into our other markets is a key sort of indicator of whether something's a positive or not. So that's how we're looking at it. And look, of course, beyond the regions we're in will become a reality. And there's a number of ways we can do that. Having a key partner on the ground is really important, like we did with Latin America, and evolve it there. But of course, in the future, an acquisition target to get a country going may be a way through it. But for the moment, very much the regions that we're in.
Okay, great, Mark. We're just slightly over time. I think we'll leave it there. Thanks very much for coming back in and giving us an update on all things BikeExchange. And if anybody's got any further questions, you can reach out to the investor relations team via the email address there.
All good. Thanks for having me, Mark, and thanks for everyone for joining.
Yeah, thanks everyone. And with that, I'm going to end this morning's meeting and wish everybody a good rest of their Thursday.